What's up, everyone? Today we're going to be learning about Jim Crammer's fourth investing rule: buy damaged stocks, not damaged companies. Okay, they're two completely different things. So let's get right into it. Damaged stocks. These are stocks that are temporarily down, and the underlying company might be good and in good shape and strong, but there's some other problems that are going on. And then there's damaged companies, which are just in the hole and they have bad managements and everything is going bad with them. Okay. So we want to invest in damaged stocks, which may be on sales and which we can get in for a lower price instead of damaged companies. It's very important that we are able to differentiate between the two companies, okay? So make sure we are buying damaged stocks and not damaged companies. So to distinguish between these, a broken stock is basically down for no particular reason. It may be due to some macro cause that may be present in the market. While a broken company, such as Groupon, JCPenney, or a lot of other penny stocks, may be completely different, okay? So when we look at Groupon, they were in 2012, they were trading for $25 per share. And today, they're only trading for a mere $3 per share. Then we look at Pier 1. Pier 1 was trading for $500 in 2013. Today, it is at $8 a share. Then we have JCPenney. JCPenney was trading at around $80 in 2007. And today, it trades at a mere $1 per share. These companies, a lot of big box retailers, have just went out of style and out of trend. Their managements have gotten sour, and things have gotten worse. The company has not been able to lift itself off the ground, and a lot of mistakes have happened over the years that have made the company to where it is today, okay? These companies deserve to get slammed and to be traded at lower and lower cost because there's something fundamentally wrong with the basis of their company, okay? Other times, there are penny stocks. In this case, penny stocks, which do not follow, they don't follow most of the SEC provided rules. They may lack publicity, okay? So they might, all their statements might not be completely accurate. Things they put out and publish on the internet for all investors may not be 100% accurate. False claims are very common, and these lead to highly speculative investments for investors. Okay, so these are home to broken companies. We want to stay away from these companies. Okay, and the majority of these times they are highly speculative and home to broken companies. Okay, not broken stocks. They are broken companies. There's something fundamentally wrong with the company, and we investors do not want to get involved with that. Okay, so sometimes stocks will sell off for reasons that have nothing to do with the underlying company and the principles. This may just be because an ETF is selling off huge amount of shares or problems with overseas issues. Okay, overseas issues. These problems are more macroeconomics. Okay, more macroeconomic issues that are more short-term and will go away, and it's not the actual company that the actual company is not the underlying problem. It's the entire market, okay? So if we're in a time of a recession, yeah, relative to everybody else, that company might be actually doing pretty good, but since we're in a time of recession, that company will obviously be traded at a lower value. So in the short term, there will be issues that arise, but as long as we're buying into not damaged companies, but strong companies with damaged stocks, we will be fine in the long term. So just because a stock is down, it does not mean that there's anything wrong with the underlying company and its fundamental principles, okay? Let me say that again. Just because a stock is down, it does not mean that there's anything wrong with the underlying company itself. As long as the company keeps a strong management team and adheres to their rules and regulations, the damaged stock, not a damaged company, soon should be turned around and making profits in no time, okay? So we want to be invested in damaged stocks, which we can get for a lower price, and not damaged companies, okay? So don't buy all at once, because a damaged stock may sometimes be a damaged company. This can be very risky and intimidating a lot of times, and may keep investors in fear of the market and not let them come back, okay? Investors will be running away from the market, okay? So how do we distinguish between broken companies and broken stocks? Well, we should form a list of the stocks we most like, okay? So when Wall Street makes the sale in markets by lowering the prices of stocks that you are looking for, that's the time to buy and build in a position for those pre-designated companies on your watch list, okay? So you want to build a watch list of strong companies that may have damaged stocks in the future where you can buy in at lower cost, okay? When Wall Street puts a discount on this company, okay, the company there's some macroeconomic issue, okay? So the company is a good company, but the price of the share maybe falls 30%, okay? That's the time to start buying in and building up a position and a stake, but only on your pre-designated companies that were on your watch list. No other companies, because a lot of times when you're getting all these companies that are just on sale, they might be home to damaged companies and not damaged stocks with strong fundamentals, strong company fundamentals. So do not just start buying on sale companies, because what you may think is damaged stock may just be a damaged company, and this may just lead you in a ton of loss and fearing the market, okay? So that's all for today. So I hope you guys learned that it is important to buy damaged stocks that are on sale, but they're held by strong companies, and you don't want to hold stocks or get into stocks that have anything to do with damaged companies that have a lack of publicity, that do not follow the rules and regulations, or are having a lot of management issues and are just very damaged at where they are. Always buy into on sale stocks with strong companies, and you will be making money on your investments in no time. Guys, I hope you learned something today and enjoyed this video. Thanks for watching.